We have a few key themes for the interest rate market for the rest of the year. First, trade peak rates. Second, curves to steepen. And third, Asian rates to trade on idiosyncratic factors. On trading peak rates, a continuation of the disinflation trend is key. Disinflation shall be good enough for the market to trade on the peak rate narrative, despite hawkish central bank rhetoric. While there may still be additional tightening from some central banks, we are already in the late stage of the tightening cycle. Taking a step further, investors may need to look beyond the near-term risk of further tightening and to prepare for potential monetary easing. For the US, we believe the US economy is heading for a recession in the coming 12 months. So we have penciled in 150 BP of rate cuts by the Fed for 2024. As the market moves ahead, the pricing of rate cuts shall carry an increasingly heavier weight as time goes by, and that will affect US yields on different tenors. Apart from the inflation and policy rate outlook, US dollar liquidity is another thing to watch out for. So far, dollar liquidity is supportive despite quantitative tightening and despite the concentration of US T-bill issuances. This is to a large part thanks to the funds parked at the Fed's reverse repo facilities. These funds have been released back to the market to offset liquidity drainage. We believe these funds will still serve as a buffer, but there is no space for complacency either, as quantitative tightening is ongoing. On the curves, if history is any guide, the US yield curve shall steepen when peak rate is confirmed. The timing and tendency of curve steepening after the peaking of Fed funds rate differed across previous cycles. For example, at the 1999 to 2000 cycle, the 2/10 segment bottomed out 3 months after the Fed funds rate peaked. At the 2004 to 6 cycle, it took 5 months. Since the curve is deeply inverted now, we expect the steepening momentum to kick in earlier. Factors that would prevent the curve from steepening may include a more hawkish Fed than currently in the price, which push up front-end rates, or a worse than expected economic outlook, yet there is no monetary easing. On the third theme, Asian rates to trade on idiosyncratic factors. Asian rates have outperformed US dollar rates substantially throughout this rate hiking cycle, meaning Asian rates had not increased by as much as US dollar rates did. Looking ahead, we do not expect to see further across-the-board outperformances in Asian local markets because yield differentials with US Treasuries have already been much compressed. That said, idiosyncratic factors in Asian local government bond markets are anchoring domestic rates and may keep yield differentials narrow for now. These factors include a sanguine bond supply outlook and a neutral to mildly soft monetary policy outlook. Against this backdrop, while government bonds in Asia may continue to be supported by domestic factors, a strong comeback into Asian local currency government bonds is not on the horizon yet. There will be more sustained bond inflows when US dollar rates ease more rapidly, a scenario which may kick in towards year-end or as we enter 2024. To sum up, a continuation of the disinflation trend shall be good enough for the market to trade on the peak rate narrative. Investors may even need to look beyond near-term risk of further tightening and to prepare for potential monetary easing. On the curves, we expect the Treasury yield curve to steepen, especially when peak rate is confirmed. In Asia, idiosyncratic factors are anchoring local rates and may keep yield differentials over US Treasury narrow until US dollar rates ease more meaningfully.